All right, let's dive in. Today, we're tackling what might just be the single hardest part of investing. And here's a hint. It has absolutely nothing to do with spreadsheets or fancy financial reports. Nope, we're talking about the battleground inside your own mind, the investor's mindset. And you don't have to take my word for it. The legendary investor Howard Marks absolutely nailed it with this quote. He said, "The biggest errors, they're not analytical, they're psychological." Think about that for a second. You can have all the data on the planet, but if your own brain is fighting you, you're pretty much doomed from the start. And that's exactly what we're going to unpack today. So this brings us to a kind of tough question, right? What if the single greatest threat to your financial future is actually you? I know, it's a bit of a gut punch. But honestly, for most of us, the real danger isn't some sudden market crash or picking a bad stock. It's us. It's those impulsive, gut-driven decisions we make when things get scary. Yeah, sometimes the enemy is literally the person staring back at you in the mirror. Okay, section 1, your brain, the enemy. And the subtitle here says it all. Evolved for survival, not for investing. So, why are we so bad at this stuff? Well, it all comes down to the fact that our brains are these incredible, ancient machines. They're perfectly wired to keep us alive on the Savea. But the stock market? That's a whole different jungle. And the very instincts that saved our ancestors are the same ones that just crush our portfolios today. Just look at this comparison. It's pretty stark. On the savannah, you see a lion, you run. And if you're the first one to run, you get to live. That's a pretty good survival strategy, right? That instinct to just bolt from danger is baked right into our DNA. But here's the crazy part. In the market, that same instinct is a disaster. When we see the lion, a big scary market drop, our brain screams, run. So we sell everything at the bottom, locking in our losses just before things turn around. It's the exact opposite of what we should be doing. And check this out, this isn't just some clever analogy, it's actual science. Neuroscientists have literally found that when you watch your portfolio tank, your brain processes that financial loss in the exact same area that responds to, a life or death threat. So that feeling of pure panic, it's real. Your brain genuinely can't tell the difference between losing money and facing down a predator. Your heart starts pounding, your palms get sweaty, and rational thought, yeah, that just flies right out the window. So we've got to have a name for these psychological traps, right? Well, in the biz, they're called behavioral risks. And the key thing to get is that these aren't just simple mistakes like messing up your math. No, these are deep, deep-seated instincts. The ego, confirmation bias, raw emotion. It's all part of the package our ancient brain delivers. And if we're going to have any hope of conquering them, we first need to meet the two biggest culprits head on. All right, next up, let's meet fear and greed, the two-headed dragon that guards every portfolio. These two might seem like total opposites, but trust me, they're equally good at destroying your wealth. They're the reason so many people end up doing the exact same thing over and over, buying high and selling low. So let's break down their tactics. Fear. Oh, fear is that screaming voice in your head during a crash. It's shouting, get out, sell everything before it goes to zero. It's what makes you hit the panic button at the absolute worst moment. And then there's greed. Greed is a bit sneakier. It disguises itself as FOMO, the fear of missing out. It's that little whisper that says, hey, look at your neighbor. He's getting rich off that new hot stock. You're being left behind. Buy now. And not feeling? That's the rocket fuel behind basically every single market bubble ever. Okay, let's look at a real-world example to make this concrete. I want you to imagine you own stock in Monster Beverages. Things are going great, you're feeling smart, and then, boom, out of nowhere, in a single month, the stock loses 40% of its value. Think about that. Almost half your money gone. The news is all doom and gloom. Experts on TV are saying it's over. Now, in that moment, what is your gut screaming at you? It's screaming sell, right? That ancient part of your brain is firing off every alarm bell it has. It's telling you to flee, to stop the pain. So be honest, what would you have done? Would you have held on? Because for anyone who didn't sell, for anyone who could fight that instinct and hold on through that terrifying freefall, the reward over the next 10 years was a 100x return. 100 times their money. That right there is the astronomical price you pay for listening to fear. Okay, so that's fear. What about greed? Well, look no further than the Japanese real estate bubble in the late 80s. You had easy loans, a buying frenzy. It was a full-blown mania. By 1989, people were absolutely euphoric. They were convinced prices could only go up, forever. That was peak greed, but bubbles always pop. When the party finally ended, the crash was brutal. It kicked off a wave of peak fear and basically erased an entire generation's wealth. And this quote from Buffett just sums up that entire cycle perfectly. What the wise do in the beginning, fools do in the end. Think about it. The smart money gets in early when things are quiet. The fools, and that's most of us, driven by that FOMO, we jump in right at the peak of the excitement, usually just in time to buy the shares that the wise are selling. Okay, so if this is the cycle, how in the world do we break it? How do we fight this dragon? Well, the good news is we don't have to figure this out from scratch. We can learn from the masters, the investing sages who fought this same battle and won. They left us a playbook. And it starts with Benjamin Graham. He was Warren Buffett's teacher, who came up with this brilliant idea of Mr. Market. Here's how it works. Imagine you have a business partner named Mr. Market, and he is wildly emotional. Some days he's jumping for joy, totally euphoric, and he offers to buy your stock for way more than it's worth. Other days he's a sobbing, panicked mess, and he's begging you to take his stock off his hands for pennies on the dollar. Graham's genius was realizing you should never, ever listen to Mr. Market's mood for advice. He's there to be taken advantage of. You sell to him when he's ecstatic, and you buy from him when he's terrified. And of course, Buffett took his teacher's lesson and boiled it down to probably the most famous investing quote of all time. It's not just a nice saying, it's a command. When everyone else is greedy and caught up in the hype, that's when you should be scared. And when everyone else is running for the exits, panicking, that's your cue to get greedy and start shopping for deals.
Then you've got Peter Lynch, another legend who reminds us that all the brain power in the world won't save you. He said, it's your stomach, not your head, that determines your fate. What he meant was, can you handle the punches? Do you have the guts to watch your portfolio drop 40% and not panic sell? Because if you don't have that emotional toughness, all the brilliant research you did is completely worthless.
So, all this wisdom from the masters is great, but how do we actually put it into practice? I mean, we can't just rely on willpower when the market's crashing. That's a losing game. We need to build something, armor, a fortress, to protect ourselves from our own worst impulses. What we need is a system. And the idea behind a system is just beautiful in its simplicity. You build the framework when you're calm, cool, and collected. When you're in a sober state, you decide all your rules before the chaos begins. That way, when the market goes nuts and your brain is screaming at you to do something stupid, you don't have to think, you don't have to feel. You just follow the rules you already made. Your past rational self is protecting your future emotional self. So, what does this system actually look like? Well, here's a great example of a top-down routine, and the order here is absolutely critical. First, you study the big picture. You look at the overall market before anything else. This keeps you grounded. Second, you check the narrative. What's the news? What are people scared or excited about? You're not looking for tips, you're just trying to understand the mood. Step 3, and this is crucial, you manage your current positions. You check your risk first. You make sure your own house is in order. Only then, once all that is done, do you move to step 4, looking for new opportunities. And finally, you journal everything, not just your trades, but how you felt when you made them. This is how you find your own psychological weak spots. And inside any solid system, you're going to find these key building blocks. Position sizing. How much are you willing to risk on one idea? Stop-loss orders. Where is your predefined exit if you're wrong? Asset allocation. Are you diversified? And again, journaling your emotions. By answering these questions when you're calm, you take all the emotion out of the biggest decisions. You make sure no single mistake can be the one that blows you up. And really, this quote from hedge fund manager Bruce Kovner sums up the whole point of a system. It's about making sure you are never in a position to lose a ton of money for reasons you can't even explain. A system is your way of staying in control, of understanding your risk, and avoiding that one massive emotional mistake that can cause total chaos. Okay, this brings us to our last section, and honestly, it might be the biggest mindset shift of all. It sounds crazy, but to win in investing, you first have to get really, really good at losing. Yeah, I know how that sounds, and it's completely backward, right? Everything in life teaches us to win, to avoid failure. But here's the deal. In the markets, you will have losses. It's not a possibility, it's a certainty. And if you try to avoid ever being wrong, you'll either take no risk at all, or worse, you'll cling to your losing stocks forever, just praying they come back. So getting good at losing isn't about enjoying it. It's about choosing your type of loss. On one hand, you have the catastrophic loss. This one is emotional, unplanned, and it can absolutely wreck your portfolio. On the other hand, you have a tactical loss. This one is unemotional, it's pre-planned with something like a stop loss. It's a small, disciplined decision that protects your capital and lets you stay in the game.
You've taken a small hit to prevent a knockout punch.
And here's how you turn those little tactical losses into gold. It's the simple formula. Pain plus reflection equals progress. See, every time you take a small loss, you feel that sting of pain, but then you have a choice. You can just get angry or you can reflect. You can ask, okay, what did I get wrong here? What can I learn? When you do that, the loss stops being a failure and it becomes a lesson. It's like paying tuition for your own investing education.
So, I want to leave you with this one last question to think about. After everything we've gone through, our ancient brain, the two-headed dragon, the wisdom of the masters, it really all boils down to this. Who is running your portfolio? Is it a system, or is it your emotions? Is the calm, rational you at the controls, or is it that fearful, greedy caveman part of your brain? Because honestly, the answer to that question will decide everything.